Okay, that's no prognostication of saying exactly when it'll happen, but I believe it will. You have to have your own decision on that. All right, let's jump into. I can jump through this this slide deck relatively quickly. I'll try to keep it tight because again, I want to take your questions. So again, if I can find my, I think this is what I'm looking for. Okay, let's see if that works. Exactly what I was looking for. Now, let me move this out. Okay, here we go. Oops. All right, give me a second. I'll find it. Here it is. All right, I've got to move some things around. Just give me a second with my fuzzy eyes after dilation. All right, here we go. All right, let's talk about opting out of Wall Street. The dentist or professional practice owner, you could say, alternate guide to alternative investments and taking control of your financial future. This, ladies and gentlemen, is the key. But you can do it. All right, real briefly, who am I? I was a clinical practice owner. We call it dentistry wet fingered. We wear gloves, so I'm not sure why we still call it wet fingered, but I did that for a little over 20 years. Real estate was really the key driver that enabled me to depart clinical dentistry, not because I was ready to, not because I wanted to, but I have a daughter who has thankfully survived and overcome a lot of health challenges, cancer, seizures, a liver transplant at age 12. But those were the causes that had me decide to at least step away from dentistry for a while. That was my original thought some 17, 18 years ago, where I could go back again. And funny thing is, I still keep my license. Like I'm going to go back. I don't think that's going to happen now. Dentistry was great, but because of the real estate and my daughter's provocation to get me to really think about what was important in my life, it enabled me to step away long enough, have that margin where I was actually able to find something new to do. And I didn't have a vision for it, but it turned into what I do today, which I actually love probably more than anything I've done in my life. And people ask, well, David, why do you do this? If you're free and, your real estate's worked so well. And I just say, look, I'll never quit wanting to be relevant to somebody somewhere. And it doesn't have to be a massive crowd. I'm not going to have to be a Tony Robbins ever, but if I can be relevant to people that I care about, that I grew up with, that I went to school with, and have a certainly understanding about the difficulties that we deal with as small business owners, particularly in our clinical practices today. And I don't have to talk about what headwinds you deal with. I know what they are. I was there. But if I can help people like you who are interested in just seeing an alternative path, something you could blend into your current path, you may buy into it, you may not, but at least you get to see something different. And that's what I'd like to share with people. As I said, I've literally helped hundreds of dentists and really it's couples. Almost everybody we work with are couples. We have a few single people who are in that position in life because that works for them, but most people are couples. And what we find is getting couples on board with the alignment of their communication about things that they haven't talked about probably in years, because you go through life, gets busy, you have raised family, you're busy in your respective businesses or practices, and you're making money and it feels good and you can manage a pretty darn decent lifestyle. But then someday it starts saying, well, how does this all come together? How do we do this? And nobody really knows. I mean, most people didn't do what I did. And I'm not saying that I'm so unique and special. It's just I've always had a very, very strong curiosity about other things in life outside of my primary training in dentistry. And I made room for that in my life. And I'm not saying it was ever easy, but it's proven to give me additional skill sets in in this case, alternative streams of income, which I think is the key diversification outside of investments. Multiple streams of income. How can you drive that? That's what gives you safety and margin when you need it, or when you want it, or just to feel more certain about your life. Freedom of time is the big one. Everybody says, well, I need more money. I need more money. I need more investments. I need more ROI in my investments. Okay, I got it. But how do you know when you have enough? Because what you want to do is be able to convert that net worth, that expansion in your investments. You want to be able to convert that back into time. Time is the key factor here that you want, even though we all think it's about more money. Because if you look at money, you'll never know whether you have enough or not. You've got to have some measurable milestones. And that's what we do in Freedom Founders. This is me. I'm on your right-hand side, not with a handlebar mustache. It's one of my best friends from dental school, but this is 83. I graduated from what was then Baylor College of Dentistry. It's now Texas A&M. But that was 83. This house was a house that I purchased with my dad's help in 1980. right in Dallas, Texas, an area called the M Streets. Well, it was actually Vanderbilt Street. Dr. Armstrong, who I also went to school with, knows about the M Streets because I think she also owned a home on the M Streets. But this is the house that my father and I purchased. Now, it didn't look like this when we purchased it. It was, a good structural house, but I wanted to get into real estate. Again, my curiosity had me reading books about investing when I was in college, and I, decided real estate was the way I wanted to go. So first year in dental school, this is the house that my father helped me purchase and manage that property there in Dallas, Texas for the next 3.5 years. Sold it when I graduated because I moved outside of Dallas a bit, and at that point didn't feel like I could manage a property. Probably was a good thing, although this property was purchased in 1980 for $83,500, and we probably put back then, I'm guessing $5,000-6,000 into it, so it wasn't huge, just cosmetic upgrades. That probably would have been about $25,000 today with inflation. Rented that house out and split about $50,000 with my dad in capital gain profit, and that was a big eye opener to me because I realized that all the time I spent waiting tables during college and dental school and made good money with tips during those days, but my return on my time value was about 10x with this one property, this one capital asset versus all those nights and weekends that I waited tables. That was my aha moment. There's something about capital assets. And so, I never looked back and I went on to buy more properties. We'll leave that story out for now. That's my daughter, Jenna, when she was 2.5 years old. Happy little kid, just normal, bouncing around like any youngster. And this is her like 3 weeks later. Looks like she has the mumps, but that's not mumps. That is part of the chemotherapy treating that high-risk leukemia. You can see she's losing her hair on the right side. That was just a very, very difficult time for our little family. And Jen survived that, but then that would be 7 years later. She's in end-stage liver failure, and now we're down in Houston, and she's been through the liver transplant. As you know, I've already said she's survived all that. She's had much better health, and her last her last 18 years have been much, much better. But I realized at that point that life was passing me by. That's really how I felt when I was sitting there in the hospital when she was in recovery, and realizing that, I had to make a choice. I could keep doing what I was doing and try to split time and sort of halfway be a dad as close as I could be, but still try to manage a practice. I got responsibilities everywhere, right? And we're typically very responsible people. We hate to let anybody down. I know that about you because that's the way I am. But my priority had to be my daughter, right? So could I make this work financially? That was the big key, right? Because again, I'm a logical, rational thinker. I'm not just like let my emotions carry me away. It's like, well, I can't just be stupid about this. I have to be financially supportive of my daughter's situation. But man, can I do this? And really, it was what I call back of the napkin calculation. I didn't pull out a financial calculator. I didn't pull out an Excel spreadsheet and run all my numbers. It didn't take a lot to do this, to figure out that I had enough to give me at least a break from dentistry, a break from owning a practice. I could always go back, but I might not ever get a chance to go back and spend the time with my daughter that I got to do. As I said, I didn't ever go back, but I could have. That was kind of my initial plan. I just need to break out of here, take the money I had from the practice sale, put it into real estate because I knew how to do that, been doing that for years, and continue to monitor I say passive in quotes because you do have to manage your assets, not directly, but you still have to oversee them. But at least I had freedom. I could manage what I need to manage through other people wherever I was. I didn't have to be local or go to a brick and mortar office anymore. That's the freedom I needed. Today, where are we in the economy? I'm going to flip through this really fast. You probably don't. We could do a whole half a day on this. I'm not going to do that and bore you. But and this may be hard to read. It's a little hard for me to read. But so the S&P and the Nasdaq. Definitely this year, obviously, last year, big correction. Yes, this last week have come back up, but I can guarantee you, ladies and gentlemen, you probably are the same belief. If you've ridden this thing back up again, you feel pretty good. Again, I'm not giving you financial advice. I'd move to higher ground. That's me personally. You do what you got to do, but I'd move to higher ground and then figure out where are you going to put your money, whether it's just sit in higher ground and go back into stocks when it drops, or you're looking at alternatives. That's the game that I'm playing right now to a great degree. And that'll come back to the question someone asked, how much do I have in cash right now in my portfolio? 70% of the GDP in this country is based on consumer spending. And again, that's been still maintained to a great degree, but understand that we have been so flooded with stimulus money going back to 2020. And even in the last quarter, there's still that ERC, the employee retention credit money, which a lot of that's just a big scam, but billions of dollars have been pumped into the economy. Now, a lot of consumers are driving their lifestyle right now on credit. The credit card expansion, the debt expansion is monstrous right now. And of course, then we got student loans that are coming back into play. Repayments have started back this last month in October. This is all pending very, very bad for the GDP because, again, 70% is consumer driven. What's going to happen when the consumers have to actually throw their hands up and go, can't go anymore? It's coming. The wealth gap, the disparity between the wealthy and what used to be the middle class is now very, very divisive now. Much greater than it was even going back to the 2008 GFC. Mortgage applications, they're down to as low as they were back in 1994 now. We're going back like 30 years. So I know people saying, well, housing's still staying strong. Yeah, it's starting to turn right now. It's turning right now. As I said, credit card debts up, delinquencies are up, auto loans debts and delinquencies are starting to climb rapidly right now. All the excess money that people took from all the stimulus money, unemployment funds, PPP loans, whatever people got, that's pretty much running out now, and that's why so much debt is increasing on the consumer side. As I said, student loan payments began. Interest rates. It's not so much how high are interest rates, but it's the relative rise in rates that we've had in the last 18 months that we've never seen before. The relative rise from essentially zero at the Fed funds rate to now 5.25 to 5.5, fastest rise we've ever had. We've had higher interest rates in the past, but not the rise. It's the relative rise that makes the difference this time. Core inflation still running very, very hot. And trust me, the stats that government gives us, they're all manipulated. I mean, just think about the stuff that you're having to pay for right now. And do you think it's really running at 4% right now? No, I see stuff today that's still running very much in the high single digits into the double digits. You just look around, they manipulate the numbers to try to make everybody think that inflation is waning. But because there's a lot of psychology behind the sentiment that we get into an inflationary period, then the Fed can't turn a dial just with interest rates and tamp it down. When people start thinking that everything's going up, then that drives it. Just look at the UAW strikes that we've had just recently, and where they got like a 25% over a 3-year raise. We had UPS drivers, a few weeks ago, got big bumps. I mean, it's everywhere right now where people are looking at this is a long-term trend. The Fed can't control that psychology. They're trying to, but they can't. Commodities, oil and gas took a big jump up, it's dropped down a little bit, but again, very, very volatile, very volatile. The deficit spending in this country by our irresponsible representatives, Congress, and the administration is out of control, and nobody talks about the debt. And that's one of the biggest elephants in the room right now as to why I believe the Fed no longer controls the markets. I'll leave it there. National debt, speaking about deficits, national debt, we started with a national debt of about 10 trillion in 2008, and we're at 34 trillion. And at the rate we're going right now, we're going to hit 50 trillion within probably by the end of this decade. And that is just not sustainable. It can't continue to do it. All right, we talked about inflation is transitory. It's not. This came out in the Wall Street Journal within the last 2 weeks. The headline was, "You're set it and forget it, 401k made you rich, no more." What we're speaking about there, and I can easily speak about this because I go back this many years, but 1980, we had the peak of interest rates when inflation was running hot and heavy in the 70s, and Chairman Volcker came in and was given the mandate to take down inflation. Well, he could do that back then because there was the political will, and we didn't have anything close to the debt that we have in this country. So he took rates up to 20%. That we'll never see that. I mean, this country would just fall apart. But he took it to 20%, and we had back-to-back heavy recessions in 1980 and 1982, big-time recessions. I was just getting ready to get out of school, so it wasn't really affecting me yet. But I do remember when I got out of school and I had a little bit of money to invest, I was getting 17% on my money market account. I thought this investing stuff is easy, right? But again, it's all relative because inflation was running hot and heavy. So 17% after taxes wasn't so good. Point here is, after 40 years of declining interest rates, which has been huge headwinds to everything that we've invested in, that game's over. That game's over. We are now in a new secular, long-term, call it decades-long trend where rates, again, they're not going to go back up to 20, but I think they're going to stay relatively high. And that, my friends, is the game changer. The old 60-40 stock bond portfolio mix, whatever the convention has been, that game's not going to work. And I would ask your financial advisor some questions. Again, not to put them down, but you've got to take control. Ask your financial advisor, how are you navigating clients like me through the current market? And just stop and see what they say. I mean, can they describe the current market? What has their attention? If they don't answer, say, well, what has your attention right now? Well, they'll say, well, inflation, higher interest rates. Okay, then tell me, how are we going to navigate that? You know, you're managing my money. How are we going to do that? I would look very carefully for some answers there. And if you don't like the answers, you got to think twice about who's taking care of you. What are you concerned about? What different strategies are you using to offset one potential disinflation, which I believe that's where we are right now. We're taking a correction mode. And then I think long-term, we're going to go right back up to long-term inflation. How are they going to navigate you or their other clients through that? Can they be specific about that? Specific. You're looking for specificity, not in stocks or bonds, but what's the overall strategy? What are the frameworks? Can they articulate that to you? This is important, folks. You've got to, if you're not doing it yourself, you better find somebody that has the experience. And look, if they're not my age, which is a little over 65, they hadn't seen it. If a lot of financial advisors, I think over 40% came out in business since the 2008 great financial crisis. How much experience do they have in this kind of market? Zero. Not making them bad people, they just don't have experience. If I'm getting ready to sell my business, my practice, again, talk to your financial advisor, and I'm going to end my active income, okay, that feels good, but it's also scary because once you end it, you can't make up for lost time. The market corrects like it has in the past. Are you prepared to go back to work and get a job again? I mean, not really what you signed up for, right? So how are they going to help you hedge? At the same time, getting you a return, that replacement income on your nest egg, can they do it? Can they do it? How are they going to do it for you? I'd get real specific with them. Have you ever dealt with a market that has both high inflation and high interest rates? Again, unless they're got some age on them, they haven't. They haven't. Got to ask those questions, folks. Lost decade. So this goes back to the 60s, which most of you probably weren't even around, or you were very, very young. But this is from the Wall Street Journal that came out this last month. A family setting aside $1,000 for their toddler's education at the end of 1965 in a 60-40, that's the standard split, stocks, bonds, ended up with $785 in real terms. That means after inflation, by this toddler's senior year of high school, that was 17 years later, they lost in real terms, what's that, $215 out of that $1,000. Now, no one can predict exactly what's going to happen, but higher chance that we're going to see stagflation, which is exactly what that was during the 60s. Stagflation. Higher inflation, anemic economy, low growth, no growth, going backwards because the inflation eats up whatever returns you're getting. How are you going to deal with that? Wall Street Journal, again, the money has stopped flowing in commercial real estate. Commercial is rolling over right now, meaning the days of high returns and turning those equities over and over again with low cost of capital, it's over. We're going to see a lot of fallout there. Banking crisis, we already saw some of that back in March. I can promise you there's more to come of this. So if you're in commercial, you're doing syndications with people who up until now or up until last year were doing great, which most people did, unless they were just absolutely poor managers or operators. You got to be very, very careful now. And I'll give you a little bit of a hint, not a hint, I'll just tell you exactly how I'm looking at it, how we're doing it in Freedom Founders. It's different than probably you've looked at, because again, most people haven't had to deal with this in recent markets. Again, back to commercial real estate. We talked about 40 years of inflation and interest rates. Looking back at the peak there was right there in 1980. And then you see 40 years of declining interest rates and inflation also down very, very low until it's come back with a roar this past year and a half. Why? Because the Fed always comes to the rescue because it's been able to in the past. Printing more money, because inflation wasn't a problem. but now it is. And that's where they can't come to the rescue again. When things start to fall, they're between a rock and a hard place. If they start printing more money, more QE, more stimulus, then what's that going to do? It's going to fuel more inflation. Inflation makes people unhappy, and we're rolling into an election year. So what are they going to do? They're going to make people unhappy because they can't feed their families, or are they going to throw out more stimulus money? See, they can't maneuver this anymore. And that's why you and your financial advisor have got to figure out, what are you going to do here? Because it's different. It is not the same that we've seen in decades past. It's totally different now. Money figuratively running uphill is what we've had for 40 years. It's not going to be that way anymore. I love this meme. If debt is the problem, how is more debt the solution? Now, again, the government, U.S. gets away with it because we've been the reserve currency for 100 years. That's also changing. Not overnight, but you've heard about BRICS. A lot of countries are sick and tired of the U.S. with the reserve currency, weaponizing it against other countries, sanctions, and just cutting them off from the SWIFT payment system. Countries are sick and tired of it, and they're starting to pull away. It won't happen overnight, but it's a trend that's coming. And it's sad to see how, again, irresponsible our representatives and administrations have been. Let's skip back. That's just, again, mortgage interest rates coming down over 40 years. Inflation that we've seen that peaked, but again, government stats peaked back in, what's that, July 22, and now it's tapering back down. But again, it is tapering, but I don't put much emphasis on the actual numbers because the government doesn't give proper stats. This is just, again, shows the vertical rise on the far left of the rapid rise in interest rates, the highest incline that we've had in recent history, going back many, many years. Let's skip that. The banks crisis. I love this from Bob Dylan, the album back from the 60s, The Times They Are Changing. Then you better start swimming or you'll sink like a stone, for the times they are a-changing. Bob Dylan back in the 60s. All right. This is a framework I want to give you all. And I'm going to try to explain this succinctly for you, but understand where I am positioned, where we're doing in Freedom Founders. Okay, left side, equity. Equity means ownership. In the financial market, that would be your stocks, right? Typically, that's where you get your growth, right? That's what everybody wants. We want big growth. We want compounding. In real estate, same thing. We want the compounding of value adds. We want to be able to use debt leverage to increase those returns, and we want the tax benefits. I mean, we want it all. And that's what happens when the market's going up. With good operators, yourself or somebody else, that's why real estate's very powerful. Until we hit a market like we're in today, where the cost of capital has gone up, and where the bid-ask price, in other words, the difference between what sellers are wanting to get because they reflect back on what they could have gotten a year and a half ago. Interest rates are higher now. They can't get that now. Buyers can't pay that. The underwriting's not there for the banks. The banks are very cautious now. The banks are in trouble. So values have to come down, but in real estate, they don't come down like they do in the stock market. So that's an advantage, in my opinion, because you don't have to try to catch that falling knife and miss out. You can take your time. So equities are great when it's time for equities. Let's go to the other side. Debt, lending, not debt as a liability, but debt as an asset, like the bank. Like debt to a bank, your debt, when you borrow money from the bank, that's a liability to you, the borrower. It's an asset, a credit on the bank's account, right? So flip it around. Can you be the bank? Can your retirement account be the bank? Can you have an LLC that makes loans or involves yourself in syndications that invest in debt as the asset and instead of equities? Yes, you can. Absolutely, you can. It's much, much safer, just like bonds are typically safer than stocks, right? But in this case, in real estate, our bonds that we can do in the alternative space are not the bonds that you get today with T-bills, which are paying much more than they did, in the last 40 years. They're paying like 5.25. That's pretty darn good as opposed to what we had just 18 months ago. But in the real estate market, again, with prudent access to the right investments, we can get minimum 10%, 12, 14, 16%. You're going, oh, well, that's crazy. Who's going to borrow money at that? They must be at bad credit risk. I can't go deep there, but you have to understand the inefficiency of real estate in the alternative marketplace gives us, the individual retail investors, the opportunity to fill the void where the credit markets, the retail markets cannot fill right now. And this is the opportune time to do it. All the real estate that I bought back in the 80s and 90s, I did it without banks. I'll say it again, I did it without banks. Why? Because I was able to negotiate terms on deals. I never had to go to the bank. Today, I lend a lot of money. Why? Because it's safer than being in equities. and it's more fungible, so that when the market does turn and rolls over more, and then it's time to go back into equities, then I'm going to move into equities. So you can move with it. It's not timing the market. It's kind of moving with the waves of the market to keep yourself safe and still get good returns. And lending money works really well in your retirement accounts when you self-direct, which is a couple of the questions that were asked here today. Self-direct there, interest income in your retirement accounts, of course, is tax-deferred in traditional IRAs, tax-free in Roth. You can't offset interest income outside of your retirement accounts, so it's not as effective there, but it's great inside your retirement accounts, just to give you a little tip there. All right, a little bit about Freedom Founders. This is what I love to do. We do blueprint days for our newest members. So I'm giving you a little bit of insight. Some of the questions were, how does Freedom Founders work? I'm going to give you that. But blueprint days is what I love to do because I get to work one-on-one with our couples, small group, and we go through 2 days of in-depth training on the frameworks of real estate. But most importantly, we bring the couples together and everybody has a unique plan. I just, off my shelves over here, before we started tonight, I just pulled off this is one stack of many stacks, but these are all of the homework of, this is just a stack of probably 12, 14 couples that have been done just in the last couple of months. Everybody's got a unique plan. I spend one-on-one time with them, digging down this, then we in a small group, we build their plan, and the synergy with the couples in hearing other people's plans, but working on their own, gives them a lot of ideation about things that they haven't even thought about talking about. And in a safe environment, the conversations that come from this bring couples together like I've never seen. I am not a marriage counselor. I've needed my own marriage counseling, but I'll tell you, the conversations that occur here is what gets people on track. It's just transformational. It's like when you finish a case, whatever your profession is, and you've helped somebody transform, whether it's their mouth or teeth, you've helped somebody with psychological problems in life, and you've bettered them. You know how that feels, the satisfaction of that, and that's what I get out of Freedom Founders. That's why I can never quit doing this until God says you're done. I can't quit. But that's the fun of what we get to do. So jumping in a little bit further, and then I'm going to come back and start answering questions here very, very shortly. But let me go quickly. So Freedom Founders community, just to give you quick insights, we're going to go quick. We vet our real estate investments. It's not a pitch. It's not like, well, who's the deal of the day? David Phelps, let me come in here because I got this great deal. We'll pitch it. And by the way, David, you're going to make a lot of money by the money we raise. And Freedom Founders, we don't take affiliate commissions. We don't take any commissions on what our people invest in. Very different from every other group out there. There's nothing illegal what other people do, but I made my mind up years ago that I wasn't going to play that game. Why? Because I want to be agnostic to what my people, my clients, if you will, invest in. I want to be able to sleep at night, not feel like I'm ever even subconsciously directing someone into a deal where me or Freedom Founders is going to make money back. We're entirely membership driven, which means I could care less. I just want people to get the investments to drive them to their goal. We have a proven system. We've been doing this for over 10 years. We have results. Results are everything, in my opinion. Results, not fake promises, not you get XYZ ROI, but results on getting to freedom. Our blueprint for creating a passive investing without you being an operator, the hands-on approach, which it's okay when you're younger and you got more time, but when you're in a point in life where you're busy, you got family, your practice is rolling, or you're out of practice and you don't want to go back and be active again, you've got to learn how to navigate this without getting your hands back in the game there. We're a community. We're a close-knit tribe. Everybody knows everybody. High caliber, high quality people. I'm the guard at the door. Will never let that quality dilute. The main problem we help practice professionals with is helping them buy back their time. I said that earlier, time. Now, we convert equity into cash flow, which again gives them the certainty to say, I can step back now. Step back, run my practice a different way. If I'm not ready to exit the practice, I can do things that I never would take the chance to do. That's a huge one that happens all the time. You're here because at least you think you've heard of other people where real estate's been a huge part of their wealth building net worth plan to create, again, that replacement income, that, again, quote, passive. If you're going to direct your own financial future, it's not entirely passive. You've got to be active or semi-active to a point. But if you care about your future, that's a good thing to learn how to do. Most high net worth investors believe that real estate should have a place in their portfolio, but how do you do it? Most dentists, most practice professionals are too busy to develop those skills. It took me, a lot of years. I mean, I've been doing it for 43 years, but let's say it took me a good 10, 12 years to figure out how this was working, right? And small deals, no big setbacks, but learning as I go. Now doing this, with larger pools of money that we help people with. By the way, we don't pool money. We don't take people's money. Again, we don't touch people's money. We connect through education and vetting of the opportunities that come to bear in our community. Accidental landlords, some of you may have tried that. It's probably, unless you have someone in your family who can actually run the business of landlording or real estate flipping, that's not something you want to do on the side. I'm just telling you, you may think you want to do it, but don't try it. We're really a shortcut. We fold time for professionals who have enough of a capital base that they don't need to put it back in their practice, and they want to get that diversification and get that going. If you're a person who's a little bit younger in career and your best opportunity is to put money back in your practice to get consulting, expand the practice, whatever it is, that's where you should go first. And we get a lot of calls. In fact, a number of you that are here tonight, I know, have had calls with some of our folks. You know that there's never hard selling. We like to act as consultants. And if there's a fit, a potential fit, we're happy to invite you to enter the realm of Freedom Founders, and we still get a chance over a period of a couple months to make sure there's a fit. If we realize that on a discovery call, that you're not a good fit, then we don't just turn you away and say, tough luck, no good. We'll give you resources. Again, we don't sell anybody's services. We don't sell any real estate, but we've got great resources. We're happy to give you those people that you can check in with that I know deliver great quality and helping people with other aspects of their life, career, practice management, to get you a point where maybe Freedom Founders would work. We're happy to do that. Freedom Founders helps you gain access to the vetted real estate opportunities, build your passive income so that you can retire with that confidence and certainty. You've got access to a community, and again, keyword community, of other like-minded professionals who have already successfully done this. And so you get the social proof. You don't have to go, well, I just wonder if Joe Blow, David Phelps, financial real estate guy is good. Well, you get to be around a group of people who you can check with. How has it worked for you? Why are you here? Why are you still here? Those kind of questions. That's what you get to do. That's how we like to do it, because we don't sell, we invite. You getting a plan, a path that you and your spouse, if that's applicable, can take, and you get to drive it, but you've got the guidance of a community that's there to support you and get you through the friction points, the things that, how do I do this? Some of the questions here, like, how do I move my IRA money? Those kind of questions. I mean, we can get you quick answers because we've done this over and over again. You can get out of the Wall Street volatility. I just think that's a big one, especially when you're stepping out of your practice. You know what that feels like. You don't want to be there, because when it drops and you're out of practice, that's not a good time to have that happen to you. If you're coachable, your debt situation is manageable. Not saying you have to be out of debt, but manageable. And we like to look for at least $1 million of available capital. Capital is not cash. Capital could be other investments that you have, taxable brokerage accounts. You may have whole life insurance policies that could be tapped. You may have, a lot of people have retirement plans, the IRAs, the 401ks, all which can be navigated to your liking at the right time into self-direction of whatever you want to do. So we like to see about that much, because we know that the return on that investment part of Freedom Founders is always there. The rest of the investment is the intangibles about really getting a plan together that you, your spouse, can actually see and you drive towards. It's a game changer when you can see light at the end of the tunnel, even if you're not quite there. Discovery call. I'm going to go and put this up here now, and then I'm going to talk through some of the questions. But if you want a discovery call, I invite you to. And again, you don't have to have those qualities. If you just want to check in and say, hey, I know that maybe I'm not quite ready for Freedom Founders, well, why don't you just have the call anyway? Because again, we're glad to help guide you and give you tips and pointers about where you could go. Maybe you are ready, but again, we'll give you guidance. So here's where you go to schedule it. We'll put this in the chat as well, so you can copy the link. You got to deal with Alex. That's the only scary part of this whole thing. If you can deal with Alex, then you're good. No, I'm just kidding. This is not Alex. Alex is on the left. Nathaniel's on the right. They're very, very adept. They've been with me and Freedom Founders both for like 7, going on 8 years. They both are investing through what we do in Freedom Founders. They've got young families, but they are very much on their goal to their freedom number at a very, very early age because of what they learned here. They've been doing this with me, with us, for, like I said, 7, 8 years. They can give you a lot of guidance. And if it's applicable, they would even set you up with a call with me. I don't take all the calls. I don't have time, but they'll triage. And if they feel like it's prudent, I'm happy to take a call because they'll do the filtering. So again, it's an opportunity for you. There's no hard selling. There's no risk to you. If you want to do that, I would schedule that. By the way, if you just because I want action takers, I don't want you to hold off on doing something that might give you some clarity, even if you're not right for freedom planners, might give you some clarity to take next steps. I've been doing a newsletter for this is like the 13th year. We started like in 2010. This newsletter, and we'll put you on our newsletter list, no charge, hard copy, comes out quarterly now. Path to Freedom. I always write the main article on something that's I think is very appropriate for people like you. Other articles in here from our securities attorney on trusts, investment trusts, how to use real estate investment trusts. I did another article on 1031 exchanges. It's a very, very, very high quality newsletter, high content. We'll give that to you, send it to you, no strings attached. The only string attached is to make you do something is you got to schedule your call, not have the call, just schedule the call by tomorrow night, midnight. That's Friday. That's the 11th. That's all you got to do. Just schedule the call. No strings. I just want you to do something. If you're on the verge of, I don't know what, I'm just trying to figure this stuff out. I think we're the best game in town to help you do that. So that's how you would go about that. Again, we'll just keep that link in the chat. I'm gonna stop my screen share because I want to jump into those questions I promised you. All right, we're 7:47 Central Time. Let's kill that. Let's go back to full screen. Let me dive into these questions. I promised you, and then I'm gonna look at your chat questions. So let's keep going here, and then we'll get anything else you want to talk about. All right, let's go to okay. In light of the current economic and political environment, what percentage of your portfolio is in cash? I would say today it's about between 15 and 20%. That's higher than I probably ever had in my life. Well, in earlier years, I never had that much cash. I was always invested in something, right? Because I was younger. Today, I'm more capital on the capital preservation side, more important to me. If I'm younger, I'm going to take a little bit more risk because I'm active income in my younger years. I can make up for not big risk, but I'll stay in the game. Now, I will say that if I didn't have access to good real estate alternative investments like we have in Freedom Planners, I probably would have a higher proportion in cash today. I'm just guessing if I didn't know anything else to do, but I was thinking about the volatility of the marketplace, being a little afraid of we're topping out here. I don't want that correction. I might put 50% of my portfolio in cash for the next quarter, 2 quarters, because I'm not worried about the effect of inflation on a couple quarters of sitting in cash with my money in treasuries at 5.25. I'm not worried about that. What I'd be worried about is taking the hit, the 15, the 20, the 30, the 40% hit. It's going to take me a lot longer to make that up. If I keep some money liquid until I'm ready to move it, when we've seen a drop in whatever equities you like, financial equities, real estate, so you can come back in right up. If you just stay in it, that what your financial advisors say, oh, just stay. You buy and hold. Buy and hold. Just it'll average out. I think that's the worst advice ever. Worst advice ever. If you've got someone who says, "I'll just stay in there," the markets always come back. You may lose a decade of time. Do you have a decade to lose? I don't think anybody here has a decade to lose. I don't care what age you are. I would just, like I said, no financial advice here. I would just go to cash. If you have a place to put your money and you have access points, then maybe a little bit less. But I'm about 20. You might go as high as 50, just depending upon what kind of prudence you have about your investments. All right, next one. This is from Doug. So he says, need help determine my ROI. This is the one he wants to buy less than 5 units. So sound like a quadplex, right? Should he pay cash or should he finance at today's rates, which will take a large down payment itself, probably 30% down today, or just pay all cash? And then he says, I hate debt. Okay, totally with you. Not a problem. At what point does it make sense to continue? Okay, let's take that first part. Honestly, Doug, I would invest either way in the quadplex. Why? Because you're buying at the top of the market. Whether you use cash or use leverage, you're buying at the top. Let this market correct. I don't care what market you're in, it's going to come down some markets more than others. I would If you don't have the ability to lend money into real estate, then just go to T-bills. I know your idea is I got to get in this marketplace. Now's not the time for most of you. Most of you, this would not be the time. So I hope that helps you. Not the answer you wanted, but I'm just telling you, this is what I tell my members and Freedom Founders. We're not investing in equities like that right now. Oh, we did in years past. Oh, we used a lot of leverage when we could get loans at 3.5%, 4.5%. But it's ridiculous today. Your loan's going to be at least 7.75%, 8.25% for investment properties. That makes no sense at all. Just no sense at all. Don't do it. Don't do it. Okay. Your second question, part of the question was, at what point does it make sense to continue participating in our large multifamily group? I don't know anything about your group. Okay. So I can't really qualify my advice on that. But I'm saying the same thing. In general, multifamily, dicey right now. There is so much in the pipeline that's coming on. Rents are already coming down. What kind of loans are you getting today? If you have a project that's not stabilized and you're doing a typical value add, you're only going to get short-term money, construction or bridge loan money. That's a dicey place to be in this marketplace. Wait till the market shifts. I would not be in a hurry to get in any kind of equities, multifamily, self-storage, mobile home parks, unless you've got access and you know you're getting a killer deal. But how do you know that if you haven't done this enough? It's hard to determine that. Or you say, or launch out on your own. I'm not sure what that means, Doug. I don't know what you do. I don't know how much experience you have. Again, I think for anybody who's just getting ready to launch out into real estate right now, very, very difficult time to do that because we're just changing so much right now. I wouldn't do anything on my own. If you want to learn more about this, I'd go under somebody else who has years and decades of experience, that has a great operation, that has the wherewithal to understand the markets, and just kind of work with them. If you really want to learn this, don't do it on your own right now. It's very, very dangerous time. And I'm not demeaning your desire, Doug. I'm just saying this is just, again, I don't know you, okay, but this is my advice without knowing you. Hope that helps. Guy Peabody, this is a question that had a lot of moving parts. I'm going to try to take this and break it down quickly, but it's probably a question a lot of you have. How to get our IRA stock holdings into passive income producing real estate with minimum tax consequences. Okay. As long as you keep your funds within the retirement account, you can sell whatever you've got if you're in financial products and keep the money there and then self-direct that into any kind of real estate you want to. You only pay tax if you take the money out of the IRA, but you don't have to take it out to invest in real estate. You've got to move it to a self-directed custodian, Guy. There's many in the country. Just Google self-directed IRA custodian, and you'll find many. They will help you do this. So don't have to pay taxes, okay? Just to make sure that's clear. Everybody should understand that. You can invest in real estate through your retirement accounts without taking the money out. Once you take the distribution out, it's a taxable event. Don't need to do that. Unless you're 59 and a half, you want to take it out, then you don't pay the penalty, but you still pay the tax. Take it out before 59 and a half, tax and penalty, double hit. Don't want to do that. So we took care of the tax consequences. If self-directed IRAs are the answer, which I'm saying they are, then explain the logistics involved to do that. Okay, it's not hard. You, again, align yourself with a self-directed custodian because they're in business to help people like you move their retirement accounts into a self-directed component without paying any tax. They'll walk you through it. The mechanics have been done for decades now. So that's all a given. All right. Just trust me, that can be done. Just connect with them. So that'll help you with logistics. All the things you need to handle RMDs. Okay. RMDs, required minimum distributions. If you are age, I think it's 72 and a half now, with a traditional IRA, not a Roth, traditional, you have to start taking out distributions based on what's the word I'm looking for? The annuity. It's not the annuity. Sorry. Based on the annuitized tables of your lifetime, you've got to take out so much. Again, there's tables that give to you how much. So if you're at that point where you've got to take out RMDs, well, you've got to keep some liquid cash, in the IRA to pay for that. You can't just invest it all, because when you have to take out an RMD, it's got to come out in cash. You can't take out a piece of your property and call that an RMD, right? So the strategy is just never overinvest. Make sure you know what the RMD schedules are. Again, your custodian will help you with that. And it's a calculation. You can Google it and find out what that RMD is for you based on the value of the account and what your age is. And you'll say, okay, I need to take out $17,000 a year, whatever. Then make sure you have at least $17,000 liquid in that account every year before you hit that timeline at the end of the year. You've got to take the RMD. All right, I think I covered that. Hope that helps, Guy. Freedom Founders entry. So I think this is from Michael, wants to know kind of how membership works. So I talked about the benefits of membership, kind of who we look for, how entry does happen. It's through an invitation, discovery call, great way just to ask more questions. Again, no sell. It's only by invitation. I don't care if you can write a check or not. We'll have to make sure that you're a good fit because I want success stories. All right. I don't want to be in our group and 6 months later going, well, this wasn't a good fit for me because, well, no, we're gonna flesh all that out ahead of time. So you did a discovery call. As I said, we're membership driven. We don't take cuts out of what you invest in. I don't care how much you invest. You'll never hear that from me. What'd you invest in this year, Michael? We don't keep score on that because it doesn't matter to me. So there is a monthly fee. You can annualize it. It's $6,500 a month. That annualizes to about $78,000 a year. You've got two components. You've got a mastermind community and you've got the investment capacity. The investment may sound significant, but the transformation, the problem solving that we do for the right people is huge. It's equivalent. I'll just tell you that. Again, how do you know? If you get an invitation, you can come. You can do what we call mutual assurance. You can enter our membership if we invite you for 2 months, 60 days. We both get to make sure it's a good fit. If we either one of us decide, wasn't quite the right timing, which is sometimes happens, we refund everything. You come back later when you get XYZ done, taken care of, we're all good. We're real easy to work with. We're very transparent, very authentic. That's how the membership works. So you said, or is there a percent paid on the amount of invested? No. That's why we have a significant membership investment, because we're not taking cuts out of what you invest. We leave all that there for you. You get your full return on investment. We're not taking slices out of it, okay? Big difference on the other assets under management people. Most other people do it that way. You don't pay them anything, but they're getting paid. And so essentially you are paying them indirectly. Just realize that there's never a free lunch out there. Your question is, do you have to jump in and invest a minimum amount? Nope. Like I said, don't care what you invest in. There's going to be no one pushing you to do that because, again, I don't care. I only care that you're investing in the right thing for you to get the results that you want. We do work that out on your blueprint day. You say, or can you dollar cost average investment over time, a monthly, quarterly? Of course. Of course. I mean, we want people to start slowly. We want you to get the education, the frameworks. We want to help you get the relationships. And keywords relationships, not with the other community members, that's key, but also our service providers, the one who brings the investments. We have an investment review committee composed of an outside securities attorney and a chief financial officer who do underwriting to a very heavy level, so we can look at, through their eyes, what are we actually looking at? What questions do we not have the ability to ask? Because the cost, quite frankly, to vet or underwrite a single fund or a syndication, it's in the mid-teens, 5 figures. I couldn't do that on my own. It wouldn't make sense. But as a community, you leverage the community. There's no other groups that do this. Trust me. You've probably been in some. You go, you get pitched, but there's no third-party underwriting anything. No, you just get pitched. So that's a huge difference in what we do. We're not claiming to be perfect. There's no guarantees, but we give a lot of certainty and confidence to our members who appreciate what we do in that regard. So yes, can you dollar cost? Absolutely. Absolutely. That's a good way to go, especially in the marketplace right now. Do some over time. Keep money on higher ground. And then as you get confidence and understanding, you can start allocating funds appropriately for you. It's your plan. We help you with your plan. All right, next question. We are in our 60s and our situation looks fine, but what are the wisest steps going forward to preserve our capital, yet continue to earn without having to spend a lot of admin time? So again, depending on what buckets of money, this is Judy's question, what buckets of money you have, meaning taxable money, retirement accounts, you may have some of both. Easy place for retirement accounts is put it in the debt funds, debt as an asset, the lending component. Much safer than equities, especially right now, and you can get great returns. If it's taxable money, you kind of have to make decisions. As I said, I'm not real heavy into equities. It's got to be something that I really say, okay, this is an opportunity. We're going to see more of those coming in the next year, into 2025, probably 2026. anything like 2008, we had opportunities clear up into 2013, 14, where we're still getting great deals. It's a slow downturn in real estate. The financial markets typically drop like a rock, and real estate will follow suit over time. Time's the opportunity. You don't have to go fast. But yes, preservation of capital is your key. So I'm telling everybody, be wary of real estate equities today. Be wary, okay? There's going to be a lot of damage out there. Not people that were frauds or necessarily corrupt. There's those people, yes, that are running Ponzi's, but there's people that just don't know what they don't know. They're not trying to harm anybody, but they just only know one game and they don't know how to pivot. Never been there before, and they're going to get taken to the slaughterhouse. And unfortunately, also will their limited partners. So I would be careful about equities right now. Be patient, be patient, be patient. That's what I tell our Freedom Founders members. This is a time to exude patience. All right, I think we had one more question. Now I'm gonna look at the chat. How are we doing? We are right at the top of the hour. Okay. What was the other question we had here? I think I've covered really the questions that came here. All right, Alex, let's go to chat. What do we got in the chat?
Hey, David, we have just a couple of other questions that have come in here. One is from, well, they kind of tie together. They're related to retirement accounts. So one is from Jeff Pearson. He asks, do you recommend funding IRA retirement accounts?
I'm okay with funding IRA retirement accounts. I'm not even opposed to someone who's younger and has the ability to even fund a 401k for a short time. Why? Because you can take a traditional IRA account, which again you can fund. You could take your 401k, add to it for, if you're younger, 2 or 3 years, whatever you feel like, build some money up in it, and then you can do a backdoor Roth, which means then you can convert it to Roth. That would be the only reason I would fund an IRA or a 401k for a limited time. Once that money goes in those traditional accounts, they're in a lockbox. And I don't like that, okay? But there is a game to having a Roth. You don't have to have a big Roth. If you start with just a nominal Roth, I'd say if you could get $20,000, $30,000, $40,000 in a Roth, it can be a game changer. Over years, you can max that out. I've got several Roths for my daughter. We started back when she was like 6. She's got high 6 figures just because we work the money. All right. So that's what I would say about that. You think that handles it, Alex? Okay.
That's great. And then the last question here is from Joanne, and she asks, what specifically do you recommend for the diversification of assets? The majority of our assets are already invested in real estate, both income producing and non-income producing, in parentheses, appreciating.
Yep. Well, yeah. I mean that kind of diversification certainly made sense coming up to where we've changed in the cycle, in the last 18 months. I mean, that's perfect because again, we had an up market, right? So having income and then having a growth component to hedge against inflation. There's nothing you can do because I've got the same thing. I've got some money in growth, and my fingers crossed with good operators is they will manage through this volatile period with good operations, and the growth probably is going to stagnate, the stagflation. But as long as on the back end we don't take a dive or we don't lose the asset, I'm okay. It's just the market. We couldn't predict this, right? Now so whatever you have there, if you can liquidate or get an opportunity for some of that growth to liquidate, then I would definitely now move it to income producing, which in my framework tonight would be into debt lending for now. Even if it's a taxable account, okay, so what? You got to pay tax on the interest. So what? It's safer, right? And you can still, with good access points, get into the double digits. Going forward, so I've got new capital that I want to invest. For diversification, I would just again diversify into debt funds, lending, debt syndications. I want to stay on that side of the equation between debt and equity right now. I'll wait to diversify back into growth or growth equities after the market does whatever correction it's going to do, and we've still got to watch for that. We're at the beginning stages, and it will start to roll, in my opinion, into this next year and probably into the next year. You just kind of have to watch it go, and then there's ways. You never know when you're at the bottom, right? You never can tell. But there's certainly mathematical formulas that are easy to use where you can say, okay, does this equity play make sense now? And that has to do with demographics, what are rents in a certain area, what's going on with the rest of the economy, recession. You can start to see, is the equity value commensurate with or relative to the floor rental income? Does that make sense now? Right now, the values are too high, right? So watch them bump, 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 bump. Okay, here, we may not be at the bottom yet, but I know that the cash flow margin on a good operation, not some ground up development, I mean running right now, okay, it makes sense. If it still goes down a little bit, so what? It's going to come back up. That's how we diversify. Diversify more in debt funds now. Watch for growth. Whatever you've got in growth right now, probably have to ride it through because that money's probably locked up, right? Usually is for a while till the exit. Now's not a good time for most growth operators to exit because of where we are in the marketplace. It is what it is. Hope that helps. Okay, let's see. Okay, yeah, got that. Okay, there's some other questions that came in right before the webinar, but I don't know that I have my hands on those.
The one other aspect of her question, for Joanne's question, David, is with regards to 401ks, and she's asking what's the specific pathway to getting assets out of Wall Street. In her case, these assets are 401k and 403k from a previous employer.
Previous. Well, if it's previous employer, then you have the right to move those to your own custodian, whether that is Schwab, Fidelity, Vanguard, or in this case, you probably want to do alternatives. So then you can move it to a self-directed custodian and invest in alternatives. You can't typically do that at all when you're still employed, right? With the employer, you have to stay in their plan as an employee. But if that's terminated and you've been out, yeah, anytime you should have absolute right to call the administrator and say, hey, I want to move my money, and then you just coordinate with whatever custodian you want it to go to. They'll coordinate, move the money over for you, and it takes a little bit of time, right? I mean, it's not like a phone call. I mean, they'll make you go through some hoops, but yeah, that's how you do it.
Excellent. One other question just came in a few moments ago, David, and that is, how does your platform compare to Fundrise and similar products? Okay,
well, crowdfunding. Well, we don't. Number one, crowdfunding is where you can take different dollars of denomination, put it with a crowdfunding source like Fundrise, and they'll put it out into various investments. You're not going to get a deep dive look or any underwriting those investments. You're just trusting that these people that are operating know what they're doing. We don't do that. And again, there's no Freedom Founders Fund. Okay, you don't come to Freedom Founders and say, "Hey, I'm gonna put $100,000 in the Freedom Founders Fund." No Freedom Founders Fund. We have separate, vetted, third-party sponsors, operators that we have vetted. They don't get to just come in one day because, hey, I got the deal of the day here. No, these are long-term relationships of people that you get to know. So that's the big difference there. The other thing with the other problem with funds, this is again general, so I'm not pointing a finger at Fundrise specifically, but when people run off of funds and they aggregate capital, and there's been a lot of capital looking for yield in the last several years, right? I mean, that's part of why the financial markets and real estate have gone up. All these trillions of dollars that came in the marketplace because of COVID, and really after the great financial crisis, the Fed has just been pumping money in the system big time, right? That money goes somewhere. It's supposed to go in the hands of people who need it, but that very little trickles down. It mostly goes into people that already have assets. And so fund managers have had a heyday in the last half a dozen, 8, 9 years, really the last 3 years until now, because all this money is coming their way, and they can almost blindfold themselves and put the money out with various sponsors, right? And unless the sponsor was corrupt or just not adept at all, the fund would make money and return, 8, 9, 10, maybe 11%. Darn good, right? Problem is today, are those fund managers, do they have the experience and the competence to know what to do with that money today? How hard is it if you've got money coming into your fund because people are still looking for that high yield you got in the last 3 years? How hard is it for a fund manager to push that money back and say, we can't take it because we don't see a good place for it? Very few will do it. If the money's coming in, they're going to take it. because they know if they put it out somewhere, they're going to make some money. That's how they make their living. They've built up a lot of overhead. How do you stop that train? So it's a scary time to fall back on whatever we've known in the past. Again, not pointing a finger at any one group platform, but just realize that you can't base your investment protocols on what we've known, what we've seen, what people tell you they've done for their investors in the last 3, 4, 5, 6 years. It's irrelevant, unfortunately. You've got to know who the operators are. You better have a way to look behind the curtains and see where's that money actually going. Who really is actually working my money for me? Fund manager up here, you don't know what's down here. They're just telling you, we do real estate. We've done this in the last few years. Yeah, but do you really know where that money's going? You don't. It's a crapshoot. Sorry, but that's the difference. We don't do that in Freedom Founders.
We also have a couple of questions coming in from our YouTube audience, David. And one of those questions is, what do you think of mineral rights as an income-producing passive investment?
So commodities are a good place to be. I think right now, in general, I believe that fossil fuels will continue to be in great necessity and high demand globally, irrespective of green energy. And mineral rights, I like because it's a way to invest in oil and gas without any underlying debt. So it's an equity play, right? It's equity. Most equity plays that we know conventionally in the past, syndications, most funds have used leverage to get the returns higher, right? I like a platform, if I believe in the underlying asset, which is oil and gas. The operators, as you would guess, are big multinational corporations. They're not a mom and popper out there, running a multifamily. No disparaging, people that do do it well. I've got no capex, meaning I don't have to go. My money doesn't have to go fix rigs. There's no capital calls because rig broke down, over here. It's clean. Now there is some volatility in commodities. Okay, so you have to kind of have an understanding about that and be okay with it. We've seen, in the last 3 years, we've seen some fluctuation wildly in oil and gas. Okay, go back and you can figure out why. Did it last a long time? Did the downturn last? No, it was short-lived. So I like it. I think it's one of the best equity hedges for a portion of one's allocations today. As I said earlier, I'm not a big fan of most equity plays right now, but because that one doesn't use any debt, no capital calls, strong operators. You like fossil fuels? Check the box.
Great. And one more question. This is from Steven. He says, I'm house shopping now, and current mortgage rates are 7% and up, but the estimated cap rate on renting out my current home is 5%. Mm-hmm. Should I sell or rent it out, my current home?
Yeah, that used to be a good play, but not in the market today. There's still, right now we haven't seen the housing market roll over in most markets. Right? I don't know where you are, but there's still low inventory, so high demand. If your house is decent, I'm assuming it's more than decent. It's probably a good house and probably a good neighborhood, probably a high desirability. I'd sell. Yeah, you don't need to keep it now. Maybe 3 years ago would have been a good play, potentially. Today, let it go. Move your money. Don't ever fall in love with real estate as an investment. And people used to play I'll leave this house and I'll start my real estate by renting my old house out. Might have been a play for that in years past. Even then, when the market was better, I know a lot of people who even if you were in the same community, it's still pain. Unless you're going to make a business out of rentals. If you're going to make a business out of it, the market's different. Yeah, you could. All right, I went to a lot of tangents there. My overriding advice, without knowing your personal situation, would be probably don't. Okay.
Great input, David. I think that wraps it up for our questions tonight.
All right. Well, again, thanks y'all for being here. I'd love to have any of you who would like to have a call with Alex, who you're seeing right here. Nathaniel, you're also seeing his screenshot. They're good people. They can give you some good advice. And if you're interested in Freedom Founders, certainly we can show you a way that you can, without any risk, but we'll help you walk through the path the right way. The rest of you, I'll keep doing webinars, and I want to continue to sew into you any way I can. I do some other online courses during the year, and that may be a fit for some of you. We'll keep you on the list and let you know when those come up. So thanks, everybody. Have a great evening, and hope to see or talk to you soon. All right. Take care.